Hey there! Ready to dive into some year-end financial planning? It's like a treasure hunt for savings, and we're giving you the map.
That's a great way to put it. We'll uncover those hidden gems and help you avoid common mistakes. And there's no better place to start than with retirement contributions.
Yeah, 401k, 403bs, those are some big ones, right? It's easy to let them slip our minds during the year, but now's the time to make sure we're really maximizing them.
You hit the nail on the head. Many people don't realize just how powerful these plans can be. We're not just talking about saving for the future. It's also about smart tax moves today.
Right, it's like
Yeah.
getting rewarded for being responsible.
Okay, so how much can we actually contribute in 2024? Any deadlines we need to be aware of?
The limit for 2024 is $23,000 if you're under 50, and bumps up to $30,500 if you're 50 or older. And remember, consistency is key. You can't just cram it all in at the last minute.
Got it. So steady contributions throughout the year. But you mentioned something about catch-up contributions earlier. What are those all about? Ah, yes. Those are fantastic options for certain plans. Like with
Yeah.
the 403b, you can do a lifetime catch-up. Let's say you had a few lean years where you couldn't max out your contributions. This catch-up option lets you make up for that lost time.
Oh, that's interesting.
And then there's the double limit catch-up with a 457b, which essentially doubles your limit in those 3 years leading up to retirement. Supercharges your savings. Definitely worth checking with your plan provider to see if you qualify.
Great tip. So we've maxed out our retirement contributions. What's next on our year-end financial checklist?
Now let's shift gears and talk about investments, specifically capital gains and losses. It's all about strategy.
I've heard about this, but I'll be honest, it's always seemed a bit intimidating. Can you break it down for me?
Absolutely. Think about it like this. Let's say you have some stocks that have really taken off this year. Selling those that you've held for over a year can actually lead to a much lower tax rate on that profit. We're talking 0%, 15%, or even 20% depending on your income bracket.
So it pays to be patient with investments. But what about when things don't go as well? Those investments that maybe didn't perform as we hoped.
Those losses are actually more valuable than you might think. You can actually use those losses to offset any gains you made, which can significantly reduce your overall tax bill. And here's the best part. You can actually carry any leftover losses forward to future years. It's like having a tax-saving safety net.
That's a great way to look at it. Now, I've always been curious about that wash sale rule. Sounds kind of scary.
Yeah.
What is that exactly, and why is it important?
Okay, so the wash sale rule is a bit tricky. Let's say you sell a stock at a loss, but then you turn around and buy back that same stock the next day because you believe in the company long term. The IRS would see that as trying to artificially create a loss and would allow you to claim it. You need to wait at least 30 days before buying back a substantially identical security.
Makes sense. No gaming the system to get a bigger tax break. All right, so we've covered retirement contributions and maximizing those investment gains and losses. What other financial moves should we be thinking about as the year comes to a close?
Well, let's talk about something that can feel a little daunting.
Hmm.
The alternative minimum tax, or AMT.
Yeah, the AMT always sounds so complicated. Not sure if it even applies to me.
Think of the AMT as a parallel tax system running alongside the regular one. It's designed to ensure that even if you have a lot of deductions or credits, you're still paying a certain minimum amount of tax, a sort of safety net for the government, you could say.
Okay, I'm starting to get it. So who should really be concerned about the AMT? What are the warning signs?
Prepaying your state income taxes or real estate taxes can sometimes trigger it. Exercising incentive stock options too early can be another red flag. And surprisingly, some municipal bonds can also be culprits.
So it's all about being aware of those potential pitfalls and being strategic with our finances.
Exactly. Speaking of being strategic, let's talk about something that often gets overlooked. Required minimum distributions, or RMDs, especially important for those with retirement accounts.
RMDs, yeah. I know they're important, but honestly, I'm a little fuzzy on the details. Can you refresh my memory?
Of course. Once you reach age 73, you're generally required to start withdrawing a certain amount each year from traditional IRAs and some employer-sponsored plans. It's basically the government's way of ensuring you eventually pay taxes on those tax-deferred savings.
And what happens if you just forget to take those distributions?
Oh, you don't want to do that.
Uh,
You could face a hefty 25% penalty on the amount you should have withdrawn. So mark those calendars and don't miss those RMD deadlines.
okay, duly noted. Feeling like a financial planning pro already, but I know there's more to cover. What else is on our year-end to-do list?
Okay, so we've tackled those retirement contributions and made sense of capital gains and losses, even the AMT and RMDs. What other year-end financial planning secrets are we missing? Well, we've covered some great foundational stuff. But let's dive into a few strategies that can really make a difference depending on your goals. Ever considered after-tax contributions to your retirement plan?
After-tax contributions. I'm familiar with pre-tax and Roth, but that's a new one for me. What's the advantage?
It's a pretty clever way to use that tax-deferred growth to your benefit. So while the contributions themselves aren't tax-deductible, those earnings, they grow without being taxed right away.
And what about when you take the money out during retirement? How's that taxed?
Well, that's the beauty of it. When you withdraw during retirement, those earnings are taxed as ordinary income. But here's the kicker. The original contributions, because they were made with after-tax dollars, they come out completely tax-free.
So it's kind of like a hybrid approach. You get tax benefits along the way and then tax-free withdrawals on those original contributions. I like it. I'll have to ask my plan provider if that's even an option for me.
Definitely worth exploring. Now let's go back to capital gains and losses for a sec. We talked about losses offsetting gains. But what if your losses are actually bigger than your gains for the year?
That's a good point. I've had years where that's happened. What happens then?
Well, you can use up to $3,000 of those net capital losses to directly offset your regular income. So that can lower your overall tax bill even beyond just your investment income.
Okay, that makes sense. But what about losses that are more than that $3,000 limit? Do those just disappear?
Nope, not at all. You can actually carry those excess losses forward to future years, so they can be used to offset gains or even ordinary income in those future years, giving you continued tax benefits down the road.
It's like a built-in tax saving mechanism for the future. I'm really starting to appreciate the power of strategic tax planning.
You got it. And remember, when we're talking about capital gains, it's important to differentiate between short-term and long-term.
Right, the holding period matters. I remember you mentioned that earlier, but can you refresh my memory on how that affects the tax treatment?
Of course. Short-term gains are those where you've held the asset for less than a year. Those are treated just like your regular income, so they're taxed at your ordinary income tax rates.
And gains on assets you've held for longer than a year.
Those are your long-term gains, and they get a much more favorable rate, typically lower than your ordinary income tax rates, which is why it's often advantageous to hold those investments for the long haul.
Got it. Patience really is a virtue when it comes to investing. Now, before we move on, I want to circle back to the alternative minimum tax, or AMT. We touched on potential triggers, but I'm still a little hazy on how it actually works.
It can be a bit confusing. Essentially, the AMT is like a shadow tax system running parallel to the regular income tax system.
A shadow tax system. Sounds a bit ominous.
Well, it's there to make sure that those with very high incomes or corporations are paying a minimum amount of tax, even if they have tons of deductions or credits that would normally lower their tax bill.
So it's like the government safety net to make sure everyone's paying their fair share, even if they have all those fancy tax strategies in place. But how do you even know if you're at risk of the AMT?
Well, there are some red flags, like having a really high income or exercising incentive stock options or claiming certain deductions that are limited under the AMT. Those are some things to watch out for.
So if any of those apply to me, it's probably a good idea to talk to a tax professional, right?
Absolutely. They can help you assess your individual situation and navigate those complexities. Now, switching gears a bit, let's revisit those required minimum distributions, or RMDs. We talked about those penalties, but I'm curious, why do they even exist in the first place?
That's a great question. I get why it's important to take them, but I've never really thought about the reasoning behind it.
The main purpose of RMDs is to ensure that retirement savings aren't deferred indefinitely. The government wants you to eventually withdraw those funds and generate tax revenue.
So it's not just about preventing individuals from accumulating too much wealth in those tax-advantaged accounts, but also about ensuring a steady stream of tax revenue for the government.
You got it. It's all about finding that balance. Now let's shift our focus to something super relevant for those with education expenses on the horizon. 529 plans. We mentioned those tax advantages, but what else makes these plans so attractive?
I'm always fascinated by 529 plans, especially how they can potentially affect financial aid eligibility. Can you talk a little bit more about that?
Sure. One of the lesser-known perks of 529 plans is their impact on financial aid. Because the account is technically owned by the parent or grandparent, not the beneficiary, it doesn't have a huge impact on the student's expected family contribution, or EFC.
So it's a strategic way to save for college without jeopardizing your child's chances of getting financial aid. That's a huge plus.
Exactly. And another cool thing is that 529 plans can be used for more than just tuition and fees.
Really? Like what? I love expanding those possibilities.
Well, they can cover things like room and board, books, supplies, even computers and internet access if those are required for the student's course of study. It's a comprehensive approach to those essential education costs.
Wow, that's awesome. It really broadens the scope of what those plans can do. Okay, let's switch gears now and chat about health savings accounts, or HSAs. You mentioned they're tax-free, but what are the requirements for actually opening one?
To be eligible for an HSA, you need to be enrolled in a high-deductible health plan or HDHP.
What exactly qualifies as a high-deductible plan in 2024?
For 2024, the minimum deductible is $1,600 for individuals and $3,200 for families.
Okay, and are there limits on how much I can actually put into an HSA each year?
Yes, there are. The maximum contribution limit for 2024 is $4,150 for individuals and $8,300 for families.
So it's all about choosing a plan that fits both your health needs and your financial situation.
Absolutely. Now let's talk about something that can be a little sensitive, but it's important to understand. Gifting. We talked about that annual gift tax exclusion. But what about gifts that go beyond that annual limit? What happens then?
I've always wondered about the rules surrounding those larger gifts, especially when it comes to estate planning. Is there a separate lifetime limit or something?
You're right, there is.
Hmm.
It's called the Lifetime Gift Tax Exemption, and for 2024, it's a whopping $13 million. That means you can gift a significant amount of money during your lifetime without those gift taxes kicking in.
Wow, that's a lot. It really opens up possibilities for strategic wealth transfer.
Exactly. And you can use this exemption for all sorts of things, like making a big charitable donation or setting up trusts for your beneficiaries.
So it's a powerful tool for those who want to manage their wealth thoughtfully and make sure things go smoothly for their loved ones.
Couldn't have said it better myself. And speaking of thoughtful wealth management, let's touch on those irrevocable life insurance trusts, or ILETs, that we mentioned briefly earlier. They can be really important for estate planning, particularly for those with a high net worth.
ILETs have always sounded intriguing, but I'll be honest, I'm not really sure how they work. Can you explain it to me?
Sure. ILET is basically a trust that's set up to own a life insurance policy on the grantor's life. The proceeds from that policy are paid to the trust when the grantor passes away, and those proceeds aren't usually included in the grantor's taxable estate.
So it's a way to provide for your beneficiaries and minimize estate taxes at the same time. That sounds like a win-win.
It can be. It's a more complex strategy, but it can be incredibly valuable for those worried about estate taxes.
Wow. This whole deep dive has been so informative. We've covered so much. Retirement planning, capital gains strategies, gifting, even estate planning considerations. It's a lot to take in.
Well, it's clear you've put a lot of thought into your financial planning. It's great to see someone taking control of their financial future like this.
I'm always eager to learn, especially when it comes to my finances. And I'm sure our listeners are just as engaged and ready to put these strategies into action.
I'm sure they are. It's inspiring to see folks taking charge of their financial well-being.
Now, before we wrap up this segment, are there any final takeaways or words of wisdom you want to leave our listeners with?
Yes, absolutely. Remember that financial planning isn't a one-and-done thing. It's an ongoing journey that changes as your life does. You got to pay attention and make adjustments as you go.
That's a great reminder. It's easy to get caught up in everyday life and forget about the bigger picture. It's all about staying informed, adapting to those changes, and always refining your strategies.
Exactly. And don't forget, the financial landscape is constantly changing. Tax laws get updated. Investment strategies evolve. Staying informed is crucial.
True, but honestly, it can be overwhelming trying to keep up with all of it. Where can people go for reliable information?
There are so many great resources out there. Reputable financial websites, podcasts like ours, and of course, talking to a qualified financial advisor can give you that personalized guidance.
Excellent advice. And I think it's important to remember that financial planning is not just about numbers and spreadsheets. It's about empowering ourselves to live the lives we want and reach our dreams.
Exactly. It's about making sure your financial resources are working with your values and priorities to help you create the life you envision.
So to everyone listening out there, take charge of your financial future. Don't be afraid to ask for help when you need it, and remember to dream big.
A little planning now can make a huge difference down the road.
Couldn't have said it better myself. That's a wrap on our deep dive into year-end financial planning. We've covered a ton, but remember, this is just the start of your journey. Stay tuned for our next segment, where we'll explore even more year-end financial planning strategies. We'll make sure you're totally prepared to navigate the end of the year and beyond. All right, welcome back. We've covered a ton of ground already in our year-end financial planning journey. maxing out those retirement contributions, strategically managing investments, and even deciphering those sometimes confusing tax rules.
We've built a solid foundation for making informed financial decisions as we wrap up the year.
Exactly. But there's one key aspect we haven't touched on yet: charitable giving.
Ah, yes. The season of giving is upon us. And it's not just about spreading goodwill. Strategic charitable giving can actually have some surprising financial benefits, too.
I've always loved supporting causes I believe in, but I'll admit I haven't always thought about the financial side of things. What are some smart moves we can make in this area?
Well, if you itemize deductions on your tax return, you can often deduct those charitable contributions, up to a certain percentage of your adjusted gross income.
So you're giving back to the community and potentially lowering your tax burden at the same time. Win-win. But what if I want to do more than just write a check? Are there other ways to give strategically?
Absolutely. Have you thought about donating appreciated assets like stocks or real estate directly to a charity?
That's interesting. Never really considered that before. What's the benefit there?
Well, it's a great way to avoid paying capital gains taxes on those appreciated assets. You get to make a generous contribution and potentially save on taxes. Double win.
That's a great tip. I'll have to keep that in mind. Any other strategic giving options we should be thinking about?
Have you ever heard of donor-advised funds?
I've heard the term, but honestly, I'm not really sure what they are or how they work. Can you break it down for me?
Sure. A donor-advised fund is like having your own little charitable investment account.
Mm.
You put money into the fund, get an immediate tax deduction, and then over time you can recommend grants to your favorite charities from that fund.
So it gives you flexibility and tax advantages, like having a charitable savings account that I can use to support the causes I care about. Pretty cool.
Exactly. It helps you be more intentional and make a bigger impact with your giving. Now, as we wrap up our deep dive, I want to emphasize something we talked about earlier. Financial planning. It's not a one-time event.
So true. Life gets busy, and it's easy to let those financial to-dos fall by the wayside. What are some key things we should all be doing to stay on top of our financial game?
It starts with regularly reviewing your financial goals.
Mhm.
Are they still the same? Are you on track to achieve them? Life throws curveballs, so you got to be ready to adapt.
That's a great point. I know I need to do a better job of checking in with my goals and making sure my financial plan is still aligned with where I want to go. What else should we be keeping in mind?
Well, the world of finance is always changing. Tax laws get updated, investment strategies evolve. Staying informed is absolutely essential.
I agree. But it can feel overwhelming trying to keep up with everything. Where can people go for reliable information and guidance?
You've got tons of options. Reputable financial websites, podcasts like this one, and of course, consulting with a qualified financial advisor can provide that personalized support.
Those are all great resources. And at the end of the day, I think it's important to remember that financial planning isn't just about crunching numbers and staring at spreadsheets. It's about empowering ourselves to live fulfilling lives and achieve our dreams.
Couldn't agree more. It's about making sure your finances are working for you, not against you, helping you create the life you want.
Well said. To everyone listening out there, take control of your financial future. Don't hesitate to reach out for expert guidance when you need it, and never stop dreaming big.
A little planning today can go a long way towards a brighter and more secure tomorrow.
Couldn't have said it better myself. And that's a wrap on our deep dive into year-end financial planning. We've covered a lot of ground today, but remember, this is just the beginning of your financial journey. Thanks for joining us. We hope you feel empowered and ready to take charge of your financial well-being. Until next time, stay curious, stay informed, and keep those financial goals in sight.